Snap is trading at half its value. Here's why I'd buy it now. This company just had its first profitable quarter in its entire history. Its free cash flow is up 150% year over year. 25 million people are now paying a monthly subscription to use this app, and the stock is trading at almost half the price it was when the company was in far worse shape. That's what we're going to figure out today. Because once you see why this stock is priced where it is right now, the opportunity is hard to ignore. Here's what we're covering. First, the exact numbers that prove this is undervalued. Second, a path to profitability that doesn't need a single product launch to work. And third, this is the part most other stock videos skip entirely, the specific options play, and why right now is actually the wrong time to sell covered calls. But before any of that, let me show you a comparison that stopped me cold. End of 2024. Snap. Ticker SNAP is trading at $10. The narrative is all growth, all momentum. Here's what the business actually looked like underneath. Net loss, negative $698 million per year. Free cash flow, $219 million. Price to sales ratio, 3.32 times. The market was paying more than 3 times annual revenue for a company burning cash at that rate. Now look at today. The company just reported its first profitable quarter in company history. Free cash flow over the last 12 months, $609 million. That's a 278% increase from when the stock sat at $10. Price to sales ratio today, 1.58 times. Same company, half the price. But it's generating nearly 3 times more cash. Let the numbers do the talking. You're being offered a dramatically better business at half the price. Now here's where it gets interesting. This is the number most retail investors never look at. Everyone sees Snap's losses and assumes the company is burning out. And if you only look at the headline, you might agree. Full year 2025 net loss, $460 million. That's real. But here's the thing most people miss. $304 million of that loss is stock-based compensation. That's when a company pays employees in stock instead of cash. It shows up as a loss on paper, but that money never left their bank account. Here's how to think about it. Imagine your paycheck says you earn less than you actually deposited because your company counted the stock options it gave you as part of your total pay. The accounting is real, but your bank balance tells a very different story. When you look at actual cash moving in and out of Snap's business, they generated $609 million in the last 12 months. The market is looking at the wrong number. And the gap between what the market thinks is happening and what the cash flow statement actually shows, that's exactly where this opportunity lives. So where is the profitability actually coming from? This is the story almost no one is telling. Snapchat Plus, their subscription service, reached 25 million paying subscribers, growing at 87% year over year. That's nearly $1 billion in annual recurring revenue right now. An analyst at Rothschild who just upgraded this to a buy in April project, it hits $1.7 billion by 2028. Here's why that matters beyond just the raw number. Subscription revenue is high margin. It doesn't rise and fall with the advertising market. It compounds every single quarter, good economy or bad. As subscription revenue grows from 13% of total revenue today toward 22% by 2028, gross margins improve from 55% to 63%. That alone closes most of the gap to profitability. And here's the line I want you to hear clearly. They could become profitable without Spectacles ever shipping a single unit. Snapchat Plus alone builds that path. If Spectacles works, that's a massive bonus. But it's not what the thesis depends on. Now let me tell you what the bears are saying. Because they're not completely wrong. The biggest concern, North America daily active users have been declining for several consecutive quarters, down from roughly 100 million to about 92 million year over year. That's a real worry. North America is their most profitable market, over $9 per user per quarter. Bears also point to the accounting losses. In the $500 million per year, Snap is spending on Spectacles development. I've heard all of it. Here's what I say back. Every single one of those concerns is already priced into $5.78. The market has already assumed North America keeps declining. That specs fails, that profitability never arrives. That's what 1.58 times sales implies for a company still growing revenue at 12% per year. When all the bad news is already in the price, the question changes entirely. You're not asking whether Snap will succeed. You're asking whether it'll succeed even a little more than the absolute worst case the market has already priced in. And that's a much easier question to answer yes to. If you're finding this breakdown useful, hit subscribe. I break down setups like this every single week. And coming up, the option strategy. Specifically why selling covered calls right now would be a mistake. Let's talk about spectacles quickly, because even though it's not the core thesis, it's too important to skip. Snap is launching their next generation AR glasses later in 2026. There's an AWE keynote preview coming on June 16th. The market is pricing this in as a complete failure. That's what $5.78 implies. But think about who Snap already has. 956 million monthly users, 450,000 developers who've built over 5 million AR lenses, 8 billion lens activations every single day. If Spectacles even partially succeeds, you get a massive unexpected catalyst on top of a stock you already had a strong reason to own. You're getting Spectacles essentially for free at this price. Free optionality. That's genuinely rare. Now here's the part of this video that's different from every other Snap analysis out there. Most breakdowns end at here's why it's undervalued, go buy it. This one goes further. Let's say you've built a position at $5.78. What's next? Here's what not to do. Don't immediately sell covered calls. Right now, Snap's implied volatility rank, basically how expensive options are compared to their annual range, is sitting at 25%. That's the low end of the range. Think of it like selling flood insurance during a drought. Nobody's worried about flooding, so the premium you collect is tiny. You'd be capping your upside on a dramatically undervalued stock for almost nothing in return. Wait for the trigger. When the stock recovers to $7 or $8, something typically happens. Implied volatility expands, premiums get richer. That's when you start selling 30 delta covered calls at 30 to 45 days to expiration. You've already captured the move from $5.78 up to $7 or $8. Then you layer in the options income on top of your gains. One critical warning. There's an estimated earnings date around August 4th. Close all short options positions before that open. Snap earnings have historically moved 30% or more in a single session. That's not a risk worth holding through. So let's close the loop we opened at the start. How is a company with better fundamentals worth half what it was when things were worse? The answer is, it's not. The market made a mistake. At 1.58 times sales, Snap is priced like a distressed company. Meta trades at 7.3 times, Pinterest at nearly 3 times, Reddit at almost 12 times. Snap fair value based on applying any reasonable peer multiple to $600 million in free cash flow and 87% subscription growth sits somewhere between $9 and $11. That's not speculation, that's math. You buy at $5.78, you don't need spectacles to work, you don't need a perfect macro environment, you just need Snapchat Plus to keep doing exactly what it's already doing. Before this video, you might have written Snap off as just another struggling social media app. Now you know what the data actually says. Better fundamentals, half the price, and every bear concern already baked into the stock, which means you know exactly what you're looking at, and exactly when to start collecting income on top of your gains when the price recovers toward where it belongs. Now that you understand how to spot this kind of asymmetric setup, there's another stock I've already deployed real capital into that uses this exact same framework. In my view, it has even higher upside than Snap, and I broke down exactly why I chose it and what the risk/reward looks like from here in this video right here. Click it now.